2016 has been a fantastic year for SEGRO. We've delivered some strong financial results, operational performance, and we have real momentum with an exciting pipeline of growth opportunities ahead. Occupier and investor demand for modern warehouse space has remained strong, with no signs of any Brexit-inspired slowdown so far. In terms of the financials, our adjusted earnings per share are up 7.1% to 19.7 pence. Our adjusted profits before tax are up £16 million to £154 million, and that's underpinned by a 4% increase in like-for-like net rental income, a strong contribution from development completions, which have more than offset rent lost from net property disposals. Our EPRA net asset value per share is up 8% to 500 pence, driven by a 4.8% increase in the value of the portfolio. That reflects development gains, higher rents and other asset management activities, including 2 residential land sales. We've achieved a strong performance from our existing £8 billion portfolio of assets under management, whilst new development has been and remains our key engine of growth. What's caused this is continuing resilient occupier demand for modern warehousing from a broad range of business sectors, but particularly from retailers and logistics companies adapting their supply chains to meet the challenges of the internet retailing revolution, all happening at a time of dwindling and limited supply of new land and space to meet such demand. That's enabled us to achieve £45 million of new rent commitments in the year, which is 14% up on the prior year. We've delivered 422,000 square metres of new space across 34 development projects, and we have 540,000 square metres of construction in progress as at the end of the year across another 31 projects. When they're complete, they'll produce another £27 million of annual rent. And we expect to add to this from the pipeline of further opportunities under discussion. There are plenty more opportunities in the remaining land bank and optioned land holdings that we'll be bringing forward over the coming years. The balance sheet has been strengthened by the £325 million placing in September, leaving gearing at year-end at a conservative 33% loan-to-value ratio, whilst we have cash and undrawn bank facilities of more than £500 million. Looking ahead, I really am positive about the strength of our occupier markets. Investor demand for good quality warehouse assets after a short hiatus in July and August has bounced back strongly, and I don't see much that will cause it to change, at least in the near term. Our future earnings growth is well underpinned by a very profitable and low-risk development pipeline. So overall, I'm optimistic about our prospects for further outperformance, notwithstanding the broader economic and macro-political risks. And that optimism, along with our strong results for 2016, is why we've increased the full-year dividend by 5% to 16.4 pence.